Happy Friday, everyone. We are at the end of week 9. You know what that means? Only 6 more weeks till the end of the semester. Doesn't time fly when you're having fun? Yeah, time flies when you're busy, like a Truman student too. So it works out both ways. So I guess if you enjoy the work, then that's also just a boon. All right. I'm going to try to avoid the witty anecdotes and snarky comments today. And we're going to try to get through this homework. So maybe we have a few minutes before class is supposed to be over. I'll give you like 5 minutes extra. Maybe 10 if you're good. We'll see what happens. All right. That all depends on you. And of course, all depends on me, how much I'm going to talk here. Start out chapter 17, question 1714. An auditor should request that an audited entity send a letter of inquiry to those attorneys who have been consulted concerning litigation claims or assessments. The primary reason for this request is to provide what? So remember, this is our legal letter. And what do we say about the lawyers? That we can trust the lawyers to tell us everything that we want to know. Like if we say we know nothing, lawyers, you can tell us, and they'll tell us everything, right? That's what they told us, right? No, that is not correct. I'm just trying to see if you guys are paying attention. So the lawyers will not give us, they will not volunteer any information. But if we already know the information, they can verify it. What is that act of verification called? What do we call that from an auditing perspective? Let's start with the letter C and sounds like corroboration. Corroboration. There we go. Yeah. All right. Corroboration. So corroboration of the information furnished by management concerning litigation claims and assessments. That sounds like the answer that we're talking about there. It's corroboration. D is our answer. 1715. Auditor issued an audit report that was dual dated for a subsequent event occurring after the date on which the auditors obtained sufficient appropriate audit evidence, but before the issuance of the financial statements. The auditor's responsibility for the events concerning the occurring subsequent to this date to which the auditors obtained sufficient appropriate audit evidence was what? So we have two options. We can extend the date of the audit report till when the testing is completed on the subsequent event, or we can limit it by doing dual date. So remember, the dual date limits the liability to the date of the specific event reference. So that's the answer that you're looking for. And so if you were looking at the answers, limiting to the specific event reference is A. That's the limited word we're looking up there. That's all their answer is just limiting to the specific event referenced. Question 21. Which of the following events occurring after the issuance of a set of financial statements in the accompanying audit report would be most likely to cause the auditor to make further inquiries about the financial statements? So remember, this is the scenario where we're sitting on the beach in Hawaii or Tahiti or wherever you're going to be sitting on a beach somewhere, sipping your pina colada, and you get a call from the client. The client says there's information that I didn't tell you about that affects the financial statements. So you probably should be aware of this. This is one of those situations where we do want to follow up on that and make sure the case, we know what's going on. So which of this is going to be very relevant here? Obviously, it's something that has to be relevant to the financial statements that were under audit. So that's what we're looking for in this particular question. So technological development industry can affect the entire entity's future ability to continue as a going concern. That's not relevant. It's relevant to the future and not relevant to what happened in the past. And a sales subsidiary that accounts for 30% of the entity's consolidated sales, that might actually qualify as a subsequent event if it happened during the period under audit, but not afterwards. Discovery of information regarding a contingency that existed before the financial statements are issued. I think we have a winner here. Okay. This is something that existed as of the financial statement date that we did not know about. If we find out about it, we have to do additional work to test to make sure that contingency is properly treated. So this is likely our answer, but let's go through D. Final resolution of lawsuit in a separate paragraph of the auditor's report. Again, that would be something that would be a subsequent event if it occurred before the balance sheet date, but after the balance sheet date, we don't have any responsibility for it. All right, we're going to come and talk about subsequent events again, a little bit more detail here shortly, but let's move on to chapter 18, multiple choice questions. Question 1812. Auditor includes a separate paragraph in an otherwise unqualified financial statement audit report to emphasize that the entity being reported had significant transactions with a related party. The inclusion of this separate paragraph. So what do you guys think? Separate paragraph, does it sound reasonable to you all? I think that's probably good. Remember, we're talking about explanatory language and emphasis of an issue that we wanted to have additional information about. So if that's the case, we can actually include that in there. So if that's the case, we're just going to talk about C and D are not going to be our answer. Would it change the opinion being rendered? Probably not. So it wouldn't be B. So we have A, is appropriate, would not negate the unqualified opinion. As long as this doesn't affect the opinion that's being rendered, as long as this doesn't affect the quality of the financial statements, then it's fine if we want to include that as an explanatory paragraph or an emphasis of other matter paragraph, according to the ASB in non-issuer vernacular. So A is our answer. I think this actually would be an explanatory paragraph because it says specifically unqualified opinion, which is PCOB language. 1813, Eagle Company, a public company, had a computer failure and lost part of its financial data. As a result, the auditor was unable to obtain sufficient audit evidence relating to Eagle's inventory account. Assuming the inventory account is at least material, the auditor would most likely choose either. So this is an interesting question. I wanted to put some context behind this question. You will see these questions a lot in this class and possibly moving forward. So the question itself is trying to actually make sure that you understand what is the issue that's being referenced. It's not trying to dictate the severity of the issue. You don't have to determine if this is material or pervasive. You just have to determine what type of issue is it. So what do we call this type of issue where the auditor could not do their job? What's our term for that particular type of scenario? Scope limitation. Yeah, good. A scope limitation. Okay. So we're trying to actually determine what type of opinions can be issued in a scope limitation. So if we think it's a material scope limitation, that would be a qualified opinion. If it's a pervasive scope limitation, that would be a disclaimer of opinion. In this situation, it doesn't give you enough information to dictate between the two, but thankfully you don't have to. You just have to know that it's going to be one of those two, and that's your answer. So it's going to be A. Okay, it's going to be a qualified opinion or disclaimer of opinion. In many scenarios, you will have that they will ask you that. They will ask you to dictate between the two types of opinions, but not actually tell you what the severity of the issue is, so you don't have to actually make a distinction between those two. All right. Question 1816. King CPA was engaged to audit the financial statements of Chain Company, a private company, after its fiscal year had ended. King had neither observed the inventory count or observed the inventory nor by count nor concerned receivables by direct communication with the debtors, but was satisfied that both were fairly stated after applying appropriate alternative procedures. So what's going on here? We wanted to do the inventory count, but we couldn't do it. So instead, we looked at other documentation, and we believe that after looking at other documentation, even though not a strong a test of inventory, that it was sufficient to believe that inventory was fairly stated. Same thing for confirmation of accounts receivable. We couldn't send confirmations out to the customers who had accounts receivable, but we reviewed the customer documentation, maybe reviewed the invoices, and we confirmed that we think their balances are fairly stated. Is that a reasonable approach? It's not the optimal approach, but is it a reasonable approach? What do you all think? I'm fine with that. If we don't have any other alternative, if we can't do what we would like to do, then doing something that we can do is probably going to be our best option. So if that's the case, what type of opinion are we going to issue? Unmodified opinion? Everything is fine? Yep. Okay. And we say unmodified opinion, full stop. We don't need to add the emphasis of matter paragraph. Question 1819. Which of the following best describes the auditor's responsibility for other information included in the annual report the stockholders contains financial statements and the auditor's report? This is an example of the annual report we talked about. Annual report contains information that's in the financial statements. The annual report is trying to put the best spin on things, so they may fudge the presentation a little bit, but they can't lie about the numbers. The client has to be consistent about the information that's in the annual report with what's in the financial statements. They can't just outright change the numbers. What is our responsibility? Well, we have no obligation to corroborate or audit that information, but we should read it to make sure it's materially consistent with the financial statements. So that's going to be B as our answer. This is riveting, guys. I see the energy enthusiasm is just taking everybody over. I'll tell you right now. What would you rather be doing on a Friday afternoon other than talking about audit reports? Okay. Maybe talking about attestation insurance. You're in luck. I got great news for you. We're about to move on to that. Okay, here we go. Question 2116. Which of the following professional services would be considered an attestation engagement? So services, we need to know the 6 types of attestation services that are going to be listed. So remember, we have agreed upon procedures. We have prospective financial statements. We have not prospective financial statements, pro forma financial statements, compliance, management discussion analysis, and SOC. Okay, service organizations. Those are the services that we talked about, 6 services. So we're looking for one of those in this list, okay? A management consulting engagement, providing IT advice to a client, that doesn't have anything listed there. An engagement to report on compliance with statutory requirements. That was one of our services that we talked about, so B is our answer. But for the same reason, C and D are not the answer because they don't have any information there. So B is our answer here because it's a compliance engagement, which is one of our attestation services. All right, I apologize for 2117. This is a question I should have eliminated a long time ago, and I keep forgetting to do it. I have my reasons, but this is not something we talked about, so we're going to just talk about it very briefly. An accountant may accept an engagement to apply agreed upon procedures to prospective financial statements, provided that what? Believe it or not, you could answer this question. You would have to do some research if you wanted to identify why the correct answer was correct. But the best way to approach it is just simply because the answers that are wrong are very definitely wrong. An examination is also performed of the prospective financial statements. That is not a requirement of agreed upon procedures. They can be standalone. Responsibility for the adequacy of procedures is taken by the accountants. That is not true. We don't take responsibility for adequacy of procedures. We provide no assurance. Negative assurance is expressed on the prospective financial statements as a whole. Same reason, no assurance is provided. So that leaves D, the engaging party acknowledges the appropriateness of the procedures before the practitioner issues a report. That is the correct answer. You may ask, why did I include this question if I don't like it? And the answer was, this question actually used to be different in an earlier version of the book. And I didn't realize that it's updated to the question until a few years ago, and I keep meaning to change it and keep forgetting. And I say that, and I'll probably say that again next semester to the class that's going to be taking this, and say, I'm sorry, guys, but this is not a question that I would ask on the exam, but it was one that I assigned for homework. Question 21 or 20. Which of the following statements is correct concerning both an engagement to compile and engagement to review a non-public entity's financial statement? This is the type of question I would ask on the exam, because I'd expect you to know the difference between these these items here. All right, so the accountant is not required to obtain an understanding of internal control. Is that true for both compilation and a review? That is true for both compilation and review, and that is our answer, but let's go through the rest. The accountant must be independent in fact and appearance. Is independence required for a compilation? It is not required for a compilation, but it is very definitely required for review. If the accountant is not independent in a compilation, is there a caveat to that? Yes, there is. If they're not independent, they can still perform the compilation, but they have to disclose they're not independent in the report. Accountant expresses no assurance on the financial statements. How much assurance does an accountant express during compilation of financial statements? None. They express no assurance. How about in a review of financial statements? How much assurance do they express? It's limited assurance or negative assurance. No, limited or negative assurance. Accountant should perform inquiries and analytical procedures. What type of procedures do we perform in a compilation? None. We perform no testing procedures whatsoever. What type of procedures do we perform in a review? I'll give you a hint. It's D. Inquiries and analytical procedures. Okay. So those are true for review, but not true for compilation. So that's why B, C, and D are all wrong, and A is the only one that's correct. All right, moving on back to the discussion question. So we have 1725. It's really quiet in here. I can hear the crickets chirping, I'm telling you. I'm not sure what I need to do to get the enthusiasm level up. Start throwing candy out, like I don't know. Start throwing rocks. People are dodging, yeah. Probably give much worse evaluations in that situation. All right, so 1725, here's what I'd like to do. All right, so we have some scenarios here that we're trying to make a determination of how they'd be treated if they're subsequent events. So there's going to be 3 questions. Is it a subsequent event? Yes or no? Okay. If the answer is yes, we're going to move on to 2 and 3. If it is a subsequent event, what type? Type 1 or type 2? And then based on the answer to part 2, how should we treat it? Part 3. Okay. So here we go. A large account receivable from a Gronowitz company, material to the financial statement presentation, was considered fully collectible at December 31st, 2021. Agronowitz suffered a plant explosion on January 25th, 2022. Because Agronowitz was uninsured, it is unlikely the account will be paid. All right, first question, yes or no, is this a subsequent event? How many people think so? You can nod your heads, you can give me a thumbs up, you can give me a fingers up if you want, hope for afraid that you don't do that last one. All right, yes, it is a subsequent event. It is a subsequent event. Okay, what do we think? Type 1 or type 2? 1 or 2? This is 2. This is type 2 event because the conditions did not exist at the balance sheet date. They came up afterwards. Generally speaking, when we see natural disasters, those are going to be type 2 events, or catastrophic events happens. Those are going to be type 2 events. Okay. So if it's a type 2 event, what is going to be our treatment? Well, at minimum, we have to disclose this event in the financial statements. Is this likely to have if it's likely to have a significant effect on our financial statements, then we might even consider a pro forma financial statements moving forward. In this scenario, I do not think this is probably large enough to dictate pro forma financial statements, but it would definitely require disclosure, because one of the major customers is going to be basically defaulting on their debt. All right. 2, the tax court ruled in favor of the company on January 25th, 2022, litigation involving deductions claimed on the 2018 and 2019 tax returns and accrued taxes payable. Scornick had provided for the full amount of the potential disallowances. The IRS will not appeal the tax court's ruling. All right, what do you guys think? Subsequent event or not? Well, it's a lawsuit that's been resolved. This is a very definition of a subsequent event. Yes, type 1 or type 2, 1 or 2. This is 1, okay? This is 1, type 1 subsequent event. So what are we going to do? We're going to adjust the financial statements because we know what the amount of the outcome is. Therefore, we can actually adjust it for that exact amount. All right. Question 3. Scornick's manufacturing division, whose assets constituted 45% of Scornick's total assets at December 31st, 2021, was sold on February 1st, 2022. The new owner suited bonded indebtedness that went with this property. Is this a subsequent event? What do you all think? I would believe this is a subsequent event. They sold nearly half of the company, okay? So that's pretty easy subsequent event. Is it type 1 or type 2? This is one's a challenge. 2, it's type 2 events. Situations or circumstances did not exist at the balance sheet date. It's a brand new thing. So again, just like before, minimum disclosure, maximum pro forma financial statements. I think if we're selling half the company, pro forma financial statements are pretty much a given in this scenario, okay? January 15th, 2022, R.E. Fogler, a major investment advisor, issued a negative report on Scornick's long-term prospects. The market price of Scornick's common stock subsequently declined by 40%. That was not very nice of R.E. Fogler. Not very nice to do that. Is this a subsequent event? What do we think? Yes, no, maybe. I'm going to wait for you to answer, Dr. Barnes. That way I don't look foolish in front of my classmates. I think that's probably the answer that everybody's going to go with. This is not a subsequent event. This is not a subsequent event. It does not affect the balance sheet in any way. It does not affect the numbers that are being presented. It did not affect users' information. It's going to be an external impetus, so we can ignore this, okay? At its January 5th, 2022 meeting, Scornick's board of directors voted to increase substantially the advertising budget for the coming year and authorize a change in advertising agencies. Is this a subsequent event? This is not a subsequent event. This is not a subsequent event either. Advertising expenditures are probably not significant enough to be constituted as something that stakeholders would want to know about. Unless they're just entirely focused on advertising, it's like 50% of their budget. This would be a minor issue and we would ignore it. All right, well done, well done. All right, moving on, 1822. Here you guys like audit opinions. Well, I got good news for you. So we've got for each of following independent situations, indicate the type of financial statement audit report they issue and briefly explain your reasoning. Assume that each is at least material. As an additional note here, we're going to use the vernacular of whether it's going to be for the PCAOB report. So if you think it's a clean opinion, we're going to say unqualified opinion, opinion. All right. Bearfield Corporation, a wholly owned subsidiary of Sandy Incorporated, is audited by another CPA firm. The auditor of Sandy Incorporated, you have assured yourself of the other CPA firms and independence and professional reputation. However, you are unwilling to take complete responsibility for its audit work. All right. So what do you guys think? What type of opinion is our baseline going to be here? Yeah, unqualified. We're unqualified opinion. This doesn't affect the opinion. However, will it affect language in the report at all? Yes, this was the example of modified wording that we talked about. We said that modified wording occurs when there's another auditor whose a work you're not willing to take responsibility for. So that we have to actually modify the opinion paragraph, the basis for opinion section, and add explanatory paragraph to this particular report. Just to say, we're not taking responsibility for their work. We think it's fine, but we don't want to take the liability for it. All right, management of Bonner Corporation has decided to exclude the statement of cash flows from financial statements because it believes it's Enron. Because it believes that bankers do not find the statement to be very useful. Anybody think that was a funny joke? Yeah, if you know anything about Enron, it's hilarious. Okay. All right. Did I find the financial statement very useful? Is financial or statement of cash flows a GAAP required document? What do you guys think? It is a GAAP required document. That's why you all learned how to do it. So what are we talking about here? We've got a departure from GAAP that's at least material. What is going to be our opinion? There's two different top possibilities. What's that? Adverse. We have adverse. What's the other possibility? Qualified. Let's go. We're not trying to make the judgment here. If I would agree with Tyler, this is probably going to be adverse in this situation simply because statement of cash flow is pretty significant, but not making the determination it's going to be qualified or adverse. All right. You are auditing, this one makes me sad. You are auditing Diverse Carbon, a manufacturer of nerve gas from the military for the year ended September 30th. On September 1st, one of its manufacturing plants caught fire, releasing nerve gas in the surrounding area. 2,000 people were killed and numerous others paralyzed. The company's legal counsel indicates the company is liable and the amount of the liability can be reasonably estimated. The company refuses to disclose this information on the financial statements. Boy, that's dark, isn't it? Oh my goodness, this has got to have been something that has a real world basis right there. So what do we think here? Is what type of issue is this? So first of all, we've got an issue or we've got a transaction here. This is for the year ended. It's not really a subsequent event, but it's an event that probably should be acknowledged in the financial statements. Okay. If that's the case, there's going to be a lawsuit coming, and they've said that there's contingent liability that they're likely going to, that it's probable and reasonably estimable. So is that requirement is probable or reasonably estimable? Is that a requirement for disclosure or accrual in the financial statements? Yes, it's a responsibility. There has to be accrual for that particular situation because it's at least probable and reasonably estimable. Now, obviously speaking, they don't want to admit liability because that's basically saying we were at fault. All right. That's why the lawyers are kind of arguing against it. But by GAAP rules, they do have to make an accrual for the amount of their liability. And they know what that amount of liability is. So there's not really any argument against it. So this is going to be a departure from GAAP, which, as we said before, is at least a qualified opinion. And they're probably going to be an adverse opinion given the scope of this particular incident. So an adverse opinion is what's likely going to happen, but technically speaking, qualified or adverse. All right. During your audit of Kuchia Coil Company, the controller, Tracy Tricks, refuses to allow you to confirm accounts receivable because she's concerned about complaints for her customers. You are unable to satisfy yourself about accounts receivable by other audit procedures, and you're concerned about Tracy's true motives. The alliteration in this was really powerful, by the way. Tracy's true motives, I tell you. Tracy Tricks, true motives. I'm trying my best, guys. All right, here we go. What type of issue is this? So we were trying to do our job. We could not do our job. What do we call that? Scope limitation. Scope limitation. So we've got two possibilities for opinions. If we've got that scope limitation, what are our possibilities? I heard disclaimers being named as one of them. What's the other possibility? Qualified opinion. Qualified opinion first due to scope limitation. So yeah, it's two possibilities could be there. We don't know which one is, but we're going to have at least one of those depending on the severity of the issue. On a side note, if you're concerned about the motives of the controller and trying to avoid us from reaching out to customers about their accounts receivable, would that be something that you probably want to take to advice to the audit committee about as well? Probably say, yeah, I'm not sure why she didn't want me reaching out to the accounts receivable, but it may be that these are not actual legitimate customers. May want to look into this a little bit more, but yeah, that was a little bit sus to me. Although don't use the word sus, say suspicious to the audit committee. You've got to use full words, okay? Okay. They're going to say, what do you mean sus? You mean suspicious? And you're going to say, okay, boomer. Yeah, that's like that. Don't say, okay, boomer to the audit committee. All right. On January 1st, a sorry toy manufacturer hired your firm, the audit committee, audit committee's financial statements to the prior year. You were unable to observe the client's inventory on December 31st. However, you were able to satisfy yourself about the inventory balance using other auditing procedures. Is that cool? Yeah. Okay. Good with that. So we're probably going to say unqualified opinion on this one. That is in fact the case, unqualified opinion. Gelato Brothers Incorporated leases manufacturing facility from a partnership controlled by the CEO and major shareholder Gelato. Your review of the lease indicates the rental terms are excessive rental terms for similar buildings in this area. The company refuses to disclose this related party transaction in the notes to the financial statements. So ignoring the fact that we as auditors would be looking at this saying, yeah, this is not cool, okay? You can't have related party transactions of this nature. The issue at hand here is whether or not they are required to disclose a related party transaction. What do we know about generally accepted accounting principles? Are companies required to disclose related party transactions in their financial statements? They are in fact required under GAAP, okay? This is a violation of GAAP, meaning that we're going to have either a qualified opinion or an adverse opinion, okay? Now, we as auditors would probably be shouting a lot more about this for other reasons, just simply because we've identified a significant deficiency or discrepancy in the rental terms, and we want to bring that to the audit committee's attention. But from the reporting perspective, this is just going to be, this is a violation of GAAP, and so we're going to issue a qualified opinion / adverse opinion. Johnstone Manufacturing Company used the double declining balance to depreciate its inventory. During the current year, management switched to the straight line method because it felt it better represented the utilization of asset. You concur with the decision. All information is adequately disclosed in the financial statements. All right. So changing the depreciation methods. And we believe as auditors, we're like, okay, that makes perfect sense. So unqualified opinion? Yeah, okay. Question, is the change from depreciation methods from one period to the next going to affect the comparability of financial statements from the previous period to the current period? It will. So what's the caveat that we need to throw in there? Unqualified opinion with an explanatory paragraph? Yes, we have to do that. We have to do that as well. Explanatory paragraph. Okay. That was a lot of fun. What do you guys think about that? Is that something you'd like to repeat and do again? It's too bad whether you don't like to or not, so we're going to do it again. All right. This one's an interesting one. A body of mines uses LIFO for value inventory held in the United States and FIFO for inventories produced and held in foreign operations. You might do some research on this one. And if you didn't, you may not have gotten this question correct. Interesting question. Is LIFO legal? Let's first do the easy one. Is LIFO legal in the United States? Yeah, it's goofy, but it's definitely legal. Okay, it's LIFO is legal. Now, the rule for LIFO in use in the United States is if you use LIFO for financial purposes, you also have to use it for tax purposes. You can't do two different methods for financial and tax. See, I know things about tax, believe it or not. Okay, but yeah, what about internationally? Is LIFO legal in under IFRS or international accounts? Answer to that one is no, it is not. LIFO is not recognized in other national municipalities, which is why they're using FIFO instead of LIFO, because LIFO is not legal. So this is a legitimate thing that they're doing here. This would result in an unqualified opinion, which you have to know. You have to have done some research to figure that out, but it's cool. Yeah, they can actually do that because they're not allowed to use LIFO abroad. Walker Computers is suing your client Super Software for royalties over patent infringement. Well, Super Software's outside legal counsel assures you, and you agree, Walker's case is completely without merit. Super Software does not disclose any contingency related to the case. What do you guys think? Should this be a contingent liability here? We definitely don't have to accrue a contingent liability because we don't have a reasonable amount or a probable amount, but if they say completely without merit, that means that there's a remote possibility of this occurring. Under GAAP rules, do we have to disclose this? We do not have to disclose this under GAAP rules. It is not required to disclose if it's a remote possibility. Therefore, this is just fine, and we're going to issue an unqualified opinion. I like it when things go well. In prior years, Worcester Wool Mills has used current market prices to value its inventory of raw wool. During the current year, Worcester changed to FIFO for valuing raw wool. So here's an interesting question. It doesn't say anything about whether the auditor agrees with this change. Is that problematic? It really depends. Current market price, is that a GAAP approved method of valuing inventory? When you're sitting back in your 221 class or taking 302 with Dr. Eisen, and he was talking about inventory valuation methods, did he say, yeah, current valuation, current market price, that's a perfect valuation? I can't do a good Dr. Eisen impression. I'm trying my best. All right. So is it a GAAP approved method? It is not. We do not have current market prices under GAAP. Okay. So this is a change from a non-GAAP approved method to a GAAP approved method. Is that a legitimate reason for changing inventory valuation methods? I would say so. I would say so. So we can issue an unqualified opinion because this is a change from a good method or bad method to a good method. Does it affect comparability? It definitely would affect comparability if that change inventory methods. Therefore, we'd have to add an explanatory paragraph. Okay, we have to add explanatory paragraph. Upon review of the recent history of the lives of its specialized service trucks, Gas Leak Technology, what a great name, justified to change the service life to depreciation purpose on its truck from 5 years to 3 years. This change has resulted in a material amount of depreciation expense. Here's an interesting one. Okay, so we have a change in useful life, a change in estimate. Okay, now is change in estimates, is that a legitimate thing that you can do in accounting? Yeah, assuming that the auditor agrees with this, we're going to say it's unqualified. Here's the question. Is this going to affect comparability from period to period? And this is a subjective question in the scenario because we're talking about a change in estimate. How are changes in estimate accounted for under GAAP? Retroactively or prospectively? Prospectively. They're treated for prospectively, okay? Which basically means that we're not going to be worried about changes to the prior period, which implies that this is not something that's going to affect comparability. However, is there additional information in this question that implies that it might affect comparability? It says this change resulted in a material amount of additional depreciation expense, which implies that it might affect comparability. So in this scenario, I would be safe and I'd say, even though it's just a change in estimate, I would probably add an explanatory paragraph adding or explaining the situation, just because of that last sentence. During the audit of Kwame Bakery Equipment, you found that a material amount of inventory had been excluded from the company's financial statements. After discussing this problem with management, you can be convinced that it was an unintentional oversight. Management appropriately corrected the error prior to your finalization of field work. All right, what do you guys think? Adverse opinion because we don't trust anybody, right? No, this is just a simple oversight. This was a simple mistake. They were not deliberately trying to pull the wool over our eyes. Actually, yeah. So that was Worcester World Mills. Never mind. Okay. Yeah, they weren't trying to actually deceive us in any way. It was just something they did, an accident. We can accept accidents because mistakes happen. So we're going to be fine with that. Unqualified opinion. Move on. Jay Rich holds 10% of the stock in Rothenberg Construction Company. The board of directors of Rothenberg's asked Rich to conduct its audit. Rich completes the audit and determines the financial statements present fairly in accordance with generally accepted accounting principles. Well, this is easy. This is an unqualified opinion. What do you guys think? All good? Okay, we're gonna move on. Okay. Why are you all shaking your heads at me? Well, there's a problem here. What's the problem? A lack of independence. If there's a lack of independence, if the auditor is not independent from the client, what is always going to be the result of the audit opinion? A disclaimer of opinion. We cannot issue an opinion if we're not independent from the client. So disclaimer of opinion. That's the default. It doesn't matter what the audit conclusion was. The opinion is always going to be a disclaimer. Rumamu 3, savings and loans financial condition has been deteriorating for the last 5 years. Most of its problems result from loans made to real estate developers in St. Johns County. Your review of the loan portfolio indicates there should be a major increase in the loan loss reserve. Based on your calculations, the proposed write-down of loans will put Rumamu 3 in violation of the state's capital requirement. The client refuses to make the adjustment or to disclose the possible going concern issue in the notes to the financial statements. Wow, there's just a lot going on here. Okay, so here's some questions here. First of all, are there any violations or any departures from GAAP in this particular scenario? Answer is yes, clearly. Okay, there's actually 2 that can be identified. The refusal to make the adjustments, which means they're materially misstated in their financial statements. That's a departure from GAAP. Also, the failure to disclose a going concern issue, because we as auditors have said, yeah, you've got substantial doubt about your ability to continue as a going concern. And they said, no, we don't. And so they're not willing to acknowledge it, but they have to they're required under generally accepted accounting principles to acknowledge a going concern issue. So 2 major violations, which means that at least this is a qualified opinion. And at most, this is going to be an adverse opinion. Is there anything else that we need to include in this particular consideration here? If we as auditors identified that substantial doubt about the entity's ability to continue as a going concern here, do we have responsibility to add additional language? Yes. So this would also likely include an explanatory paragraph stating the substantial doubt about the entity's ability to continue as a going concern. So there's a lot going on here and it's a lot to absorb, but it's all really necessary because this is a mess. This is a mess. The company is not being correct on their statements of the financials, and it looks like they're going to be out of business in a year. This is not a company I want to be auditing. Thankfully, that's why we're in the classroom and not in the real world right now. So, all right. Last question for the day. Orange Grove Farms has approached your CPA firm with some questions. Orange Grove management has spoken with a bank about obtaining a loan to expand its operations. The bank has informed Orange Grove the bank will not make the requested loan unless the company submits financial statements. Further, the interest rate on the loan will depend on whether Orange Grove's financial statements are compiled, reviewed, or audited by an independent auditor. Orange Grove's management is not familiar with the differences between these 3 services and wonders why the interest rate charged on the loan would depend on the type of services they obtain from your CPA firm. So let's talk about the definition of these 3 items and then discuss why the interest rates will change, okay? So a compilation of financial statements, remember we defined that on Wednesday. A compilation of financial statements is putting together financial information into financial statements based on the representations of company's management. So if there's any estimates, any subjectivity that's involved, management's responsible for preparing the subjectivity, but otherwise we're just aggregating information together on behalf of the company itself, okay? So in a compilation, does a compilation provide any level of assurance? Compilation provides no opinion, okay? There's no opinion rendered in that particular scenario. We do have an attest function. There is a reporting mechanism. They do the accountant provides the report, but They do not provide any opinion or conclusion in that report. They just basically detail the work that they're performed, okay? So keeping that in mind, let's go to a review, all right? A review of financial statements. What does that usually entail? It entails limited procedures, which include inquiry and analytical procedures over the financial statements to provide limited assurance about the whether or not there's material modifications that need to be made to the financial statements. So we talk about this limited assurance or negative assurance, okay? Relatively medium level assurance, moderate levels of assurance, okay? They issue a report, they issue an opinion, although the opinion under a review is called what? Conclusion. It's called a conclusion. It's differentiated from the opinion that we use at the reasonable assurance level, okay? Called a conclusion, it's not as strong as caveat, or it's not as strong a conclusion, or not as strong as a result, that's the word I'm looking for, as an opinion. So keeping that in mind, let's move to audit. Audit. Review the financial statements, very, very thorough detail, very, very specific procedures. Try to determine the financial statements are free from material misstatement. We issue a report. We issue an opinion. What type of assurance do we render in our opinion? Reasonable assurance. Is that the highest level of assurance that we can feasibly achieve? Some of you may say, Dr. Barnes, I am an exceptional auditor. I can achieve absolute assurance. And I'm going to say liar. Okay. I'm going to say liar. Reasonable assurance is the highest level of assurance that we can achieve. Okay. So what do we know about the relationship between risk and reward in finance? So with respect to investing, okay, let's say I've got three separate items, three separate investments you can invest in. One investment is a 5% investment, one is a 10% investment, and one is the 15% investment, okay? And you have an option of investing in one of those three. Which one are you going to invest in? Don't be too rash on this one. Don't say 15% immediately. What's your answer? It's going to be, it depends, okay? Because you need to know not just what the return on the investment is, but what the relative level of risk for the investment is, okay? So there's a relationship between risk and reward, and it basically has to do with what you think the assessment of risk is. Now, does risk play into the type of engagement that we perform in this scenario? Like, say, for example, I'm looking through these the three different types of investments, okay? And I say, well, this investment has been audited, all right? Or this company has been audited. And they say, what about the other two companies? I said, well, this company has been reviewed, and the third company has had a compilation of their financial statements. How much assurance do we say is provided in the compilation? No assurance whatsoever, okay? So what does that imply about the risk that's implicit in that particular company? It's an unknown quantity, okay? It's probably a high level of risk, okay? A review, do we provide any assurance in a review? Some, more than we do in a compilation, but it's not an extreme amount, it's a moderate amount. So there's some risk, okay? What about an audit? If an audit is performed well, it's providing reasonable assurance. So there's a minimal amount of risk, but there's still some risk, but it's going to be the lowest level of risk, okay? How is the bank going to review that if they view that? If they see a high risk portfolio, they're going to say low percentage, high percentage on the bank loan. What are they going to say? Let's think about it this way, okay? Let's say that you've got a terrible credit score. No judgment against you, but you got a terrible credit score, and you go out to buy or get a loan on your car. What kind of interest rate are you going to get on that car? 30%, okay? Which, by the way, don't take that loan. Don't take that loan. All right, you're gonna have a high one because they're gonna say you're have risk associated with it, and you're gonna say, but I've got a compilation of my financial statements. So they say we don't care. There's no assurance associated with that. Okay. What about you come in and then say, all right, I realize my credit score is not good, but I had a review of my financial workings and they provided some assurance. Is that rate going to go down a little bit? Yeah, we're gonna put you at like 15%. Okay. And then finally you come in and say, I have an audit of all my financial features. It's actually affected my credit score. My credit score has gone way up. Okay. I am minimal risk. And they're going to say, congratulations, you get a 7% interest rate. And I know that sounds awful, but interest rates are awful right now. So yeah, it'd be great if you can get it. Okay. I actually just recently bought a car and I didn't get much better rate. My credit score is immaculate. Okay. My credit score, I'm the lowest risk in person in this room right now. Okay. But yeah, that's kind of the idea we're talking about here is that if we have these assurance levels dissuade risk, okay? Higher levels of assurance mean lower level risk and vice versa. Therefore, if we think about a compilation, we could expect to have a higher interest rate and audit a lower interest rate. And that's ultimately the conclusion you should come up with. And it should make intuitive sense to you. All right, I said if you were good, I'd let you out 10 minutes early. Everybody was good, so have a great weekend.